Good morning, everybody. Welcome to Mines and Money Online Connect. Thanks for joining us, and thanks also to Trade and Investment Queensland for sponsoring. My name is Marian Hookham, and I'm a director with McCloskey, now owned by Dow Jones, which is also the producer of the Wall Street Journal. We have with us today an excellent live panel, and our focus today will be on the Queensland metallurgical coal sector and the many, many challenges it faces. The bios of my speakers are all online, so please feel free to check those out. But our lineup today would include Mark Bolton from private producer Jellinbah, Tim Peirce from trading and investment company M Resources, Barry Tudor, chairman of Pembroke, the newest greenfield coal producer in Queensland, and Fergus from Kestrel Coal, a joint venture between EMR Capital and Adaro, with Mitsui as well as partner. So what I'd like to start with, just so our viewers can understand where we sit, would each of you please just run through an overview on what your company is involved with? And let's start with Mark.
Yeah, thanks, Marian. Jellinbah Group, we're a 50 million tonne per annum private independent metallurgical coal exporter. We're based in the Bowen Basin. We have two mines, two open cut mines. We're in our 33rd year of operation for one of those mines, the Jellinbah East mine, and in the 12th year of operation for our Lake Vermont mine, our newest mine. We produce both hard coking coal and PCI for export to the global steel and metallurgical coke industries. Both mines are have long life resources, and we also have a pipeline of organic internal growth stretching many years into the future. Thanks, Marian.
Thank you, Mark. Excellent. Tim.
Yes, sure. If I just introduce M Resources. So the company has its origins operating in the metallurgical coal market, more than 20 years of presence in that market, in the company. It was founded by Matthew Lattimore 2011. Since that time has represented more than 500 cargoes and greater than 30 million tonnes of coal. We're currently operating at about 20 million tonnes of metallurgical coal primarily across various supply chains, predominantly Australia and North America, and active in all key markets and in all grades. The company, I guess, is now global in its footprint and reach. In addition to sort of the core marketing activities, which are the core business for M Resources, we also presently operate the Millennium Coal Mine. We operate that in joint venture with Stanmore Resources, who we support with marketing activities as well as other entities. And the company's been active in through cycle acquisitions. So through 2021, we supported 5 mines into resuming or starting operation and coming back into the market. We're certainly still active in adjacent coal investments presently.
Thank you, Tim. Barry?
Thanks, Marian. So I'm the chairman of Pembroke Resources. We are the newest face of the Bowen Basin. So I established Pembroke Resources back in 2014 to focus on steelmaking coal. We have two operations, one in central Kalimantan, Indonesia, that is actually producing a semi-hard product and has been for about a year. But our main focus is our Olive Downs project in the Bowen Basin. It's a project that is currently under construction. It will be in production next year, towards the end of next year. It produces coking coal. It has over 500 million tonnes of open cut JORC reserve. When fully ramped up, a production profile of 20 million tonnes per annum over 79 years.
Definitely want to hear more about your journey of getting there, Barry. We'll return to that later. Fergus.
Hello,
Fergus?
Marian, can you hear me? I think I just
Yes.
dropped out there. Yep, thank you for that. Kestrel Coal Resources, we have about 6 million tonnes of production of coking coal based in the lower Bowen Basin. The mine has been running for 30 years this year, and we have long life resources going forward. The joint venture of Adaro and EMR jointly owns 80% of the mine, and the other 20% is owned by Mitsui. That 80% was acquired back in 2018 from Rio Tinto when they moved to exit the coal industry, and so that's a function of that. And we have market access around the world, from the Atlantic to the more familiar Asian markets.
Great, thank you. Thanks, everybody. That gives us a good idea of who we're talking to. So just to contextualize, Australia exported 166 million tonnes of metallurgical coal in 2021 calendar. It is the biggest seaborne exporter of metallurgical coal in the world, hugely significant. Of that volume, Queensland was responsible for 90% of metallurgical coal exports. We meet today at an unprecedented time of challenge, ESG, global disruptions, moving into a recessionary environment. Many, many challenges face us. And I think those are some of the themes that I want to talk to you guys today and hear your thoughts about those. But let's first start with the current market and prices. So something is happening at the moment which we never ever would have bet would have happened or thought would have happened. And that is the dislocation between Newcastle thermal coal prices and metallurgical prices. So we're currently marking Newcastle, say 6,000 at around $425 per tonne FOB at the moment. Compare that with a prime low vol such as Saraji Peak Downs at around $275 per tonne FOB. That's a $150 gap between what has always been accepted. Metallurgical coal has always been more highly priced. This is unprecedented. This has been going on now since I was looking at the numbers for at least around 6 months or so. So my question is to those of you who are at the forefront of selling coal into the market, how long does this last? When do you see a retraction and a retreat to normal price formation? And also, are you seeing a pull for thermal coal, for met coal to be placed into thermal coal markets? We know this is happening in the US. And Mark, let me start with you. PCI is a very logical coal to be potentially pushed into thermal coal markets. Have you seen this? Have you seen requests from buyers to place your metallurgical coal into those kinds of applications?
Yeah, thanks. Thanks, Marian. I mean, effectively, we're in almost the third year of significant market disruption. When you look at what happened with China and Australian coal, and then obviously the recent developments in the Russian sanctions, which has really driven the energy markets into the, I guess, the crisis mode that we're in at the moment. And these things are structural. Probably the Russian situation more so than the unofficial ban in China of Australian coal. We're also here in Australia in the third year of a La Nina, potential third year of a La Nina event on top of COVID, which has been working its way through the industry for the last 2 years, which has significantly impacted productivity. I mean, you talk about Australian metallurgical coal being exported 166 million tonnes. Well, 3 years ago, we're at 184. So there's a 17 million tonne displacement there. But moving to the energy situation at the moment, first question you asked is how long it will last. We're talking potentially years, given the fact that the Europeans have to work out their alternative energy import capabilities. And solid fuels at the moment remain the most cost-effective way to heat the Northern Hemisphere as they go into their winter. The ability to switch thermal, I mean, you would expect that price differential that anybody making metallurgical coal would be switching immediately over into thermal coal. Technically, It is not possible at 100%, just from a technical point of view, but it certainly gives you opportunities when you come to perhaps look at moving certain parcels of coal when you have such a strong draw in the energy markets there for solid fuels.
Tim, what about you guys? Because you have some blending opportunities potentially, and maybe some exotic solutions, which are probably secret, but anyway, your views would be interesting.
Yeah, look, I think support what Mark said. The logical move is to displace as much metallurgical coal into thermal as possible. And the longer you look at this and the harder we look at this, again, agree. There's a lot of elements that are structural. You know, we've seen multiple times trade flows. You know, it takes sort of 6-9 months to adjust to things. By the time you take into account contract positions, you know, technical qualifications, setting up new trade flows and new business, such as the switch. I think we see a clear evidence. We believe that the switch has happened. We see evidence that steel mills are facing a shortage of certainly PCI and semi-soft material versus their expectations for availability of that material presently in the market. So our view, yeah, I think certainly there's been a significant push, and if you look at simply the quantums of these markets, on a simple math, if you took a semi-soft and a PCI portion of the met coal market, and then you compare that to the size of the seaborne thermal market, those two numbers are so overwhelmingly different that there's going to be a number of options for that coal to be reallocated into different grades and different blends and be moved into an alternative market. And we think we're seeing that happen structurally now.
And Fergus, what about you guys? Have you had much interest from thermal coal buyers for your type of coal?
Yeah, we certainly have, Marian. We wouldn't be Robinson Crusoe on that. I think that probably there's a broad interest across the industry. And as Mark mentioned, there are some technical limitations, which I do believe are being challenged to a degree, and users are finding ways to adapt to a point with the different types of quality. And in line with what Tim was saying, I think the size of the market that we're talking about with the thermal coal market is so much more than what could move into that from the metallurgical coal side. It's almost like a magic pudding and what you could put in there. I think there's low-hanging fruit, which we've already seen coming out of New South Wales with thermal coal that is affecting the availability of semi-soft, and some American suppliers are successfully putting what would normally be metallurgical coal, high-vol metallurgical coal, into Europe in reasonable volumes. Our coking coal is of a high-vol variety as well, so we are able to more easily move into that thermal coal and meet the technical requirements. And that, I suppose, is one of the reasons that we do get strong interest. Of course, we have contracts that we need to meet on a metallurgical coal side, but it is a very compelling situation in the market there, where you're looking at that arbitrage in value between thermal coal and metallurgical coal. And just to touch on Mark's point there's no reason to think that this will change in the near future. The energy complex and the situation in Europe in particular is such that there's no quick solution to this as we move into the northern winter.
Thanks, Fergus. Now, Barry, you're not in production yet, but, to be frank, if you look at where PCI would be priced versus thermal coal, you'd have to be almost very slightly tempted to say, let me start marketing my future PCI semi-soft production as a thermal. Although what we definitely think is that by the time you're in production, these relationships would have reverted to normal. So any comments, Barry?
Well, we have to be in a position where we're looking at the medium to long term. So if we were to try and change strategy opportunistically, that may not end up being the best result. So Olive Downs being fundamentally, one of the strengths is fundamentally a steelmaking coal mine. Over 90% of the coal is steelmaking. So we just focus on that. There is ability for us to do different products and to blend in a different way, and we always keep our eyes on that, as most of the gentlemen on here, I think, are the same. As an independent, the focus is, more on the customers than potentially a major producing a product, and, you either take it or you don't. So I think we can be adaptive, but I think there's another factor as well, I'd say, and that is there's an enormous amount of focus, whether we like it or not, on the type of coal produced. And in order to get a new mine permitted in 2022, it had to have a minority of thermal coal. The options for financing a new mine that is thermal are extremely limited. So we're committed to steelmaking coal, as I call it. That's the way we're going. We do think that, in my recollection over the last 20 years in coal is it's fairly rough. What happens is there's a move of some tons out of met into thermal. All of a sudden, people will say, "Oh no, we're running out of met," and that'll adjust, and people will need to scramble for met, or the price will go up. So it's always tight demand supply. We just stick with what we're focused on, which is our semi-hard and hard products.
No, thanks, Barry. Look, let's turn to, I guess, the broader geopolitical environment briefly, and it's linked with what we're saying here, looking at the Ukraine-Russian dislocation in the market, where we've seen roughly 20% increase year to date in Australian met flows to Europe, directly as a result, I would argue, of that displacement. Our internal analysts think that some of these dislocations will become more fixed than previously. But the other dislocation that we've all talked about, and last year in this very panel, was the Chinese ban on Australian coal. Now, urban legend would have it, before China banned Australian coal, that China could not produce 1 billion tons of steel without us. Now, that has been proven to not be the case. I'm interested here in, I guess, a range of your views. How long do we think China can continue? We seem to be now, China's in a kind of plateau situation, as BHP internal analysis would suggest. So peak Chinese steel has probably been hit, but they could plateau at around 1 billion tons for some time. How long can China continue producing 1 billion tons without prime hard low vol? Bearing in mind, Russia is sitting there positioned to put lots of volume into China. And Mark, you were well exposed to China. You've said to me a few times, if China comes back tomorrow wanting your coal, it's elsewhere. So Mark, let's start with you. Your views on if and when China comes back, what happens?
Yeah, thanks, Marian. There was quite a lot of rumour this year, recently, based on obviously what we saw with a change at the federal government level. And also a few other sort of key triggers happening inside China, such as the price of domestic coal there becoming more expensive than the seaborne market. But structurally, their economy at the moment has some very, very deep challenges, particularly in the sectors that drive steel, such as the real estate sector there. And so whether you believe some of the growth numbers you see out of that economy at the moment, given the COVID lockdowns and everything else, looking recently at things like youth unemployment and everything like that, whether they're actually growing at all, does have an impact through to the steel market. Yes, at its height, China was taking 80 million tonnes per annum of metallurgical coal from the seaboard market. Australia was supplying half of that, and with our Lake Lamont product there, we were a fair amount of that market in that sector. When it closed, we were able to move our, and it was fortuitous at the time. The market was in a cycle where there was demand growth in India and Europe. We were able to pivot to those markets there. Europe itself, perhaps in the short term, might be a challenge, given the fact that if we take a view that there is an economic fallout, I guess, from the energy crisis coming up, we may see some slowing there. But what's important there is that through energy, you'll probably see the EAFs, the electric arc furnaces, stop their steel production as they are at the moment. The blast furnaces technically continue with their demand levels. Obviously, challenges with Rhine water levels and moving that material around. It will sort itself out. But if China was to return today to the seaborne market, not just necessarily to ourselves, it would find it quite challenging, given that those tonnes are being allocated elsewhere into various market regions from a lot of producers. And the contract cycles can take 6 to 12 months to move, given that everyone is fairly well contracted at the moment, given that demand is still very strong. Even at the high prices, there isn't a lot of spare coal around there for various supply issues here in Queensland. We would take it. We would take it on a case by case basis. We would cross that bridge when we come to it. Speculating about what that market will do when it opens up for its unofficial ban. That is, you can spend a month of Sundays working your way through that.
Tim, M is quite well exposed to Japan, JKT, and kind of has been for a long time. Japan stable, slowing population. Steel being offshore to some extent. Nippon seems to think that steel production will more or less flatline and start to ease back in Japan. So your core markets, when you're looking at a marketing strategy, give us the kind of top points there. How do you think about the world going forward now?
Yeah, fair question, Marian. I think I don't think we're controversial in our assessment there that the blast furnace, the dominant market for the blast furnace is going to remain India and Southeast Asia. That's where that technology is going to maintain and grow its market share. So that would naturally be a focus for us. In aggregate, though, Europe is still a very large market at present, and as you pointed out in trade flow stats, Australian market share there has grown substantially this year, and that's not necessarily a trend that changes in the near term. We would expect.
Fergus, I think, correct me if I'm wrong, but you're largely tied to contracts. I would imagine, I'm making this up, but you've probably got 10 to 15% available to play in spot at any given time. Going forward strategically, how do you position your book vis-a-vis China, if at all?
I think I would hark back to Mark's comment there that it's a bit you'd have to make that decision at the time that it was to reopen and what the market is at that time. But essentially, it turned off quickly and without a clear message, and it may come on like that as well. It may come on quietly without us knowing, just starting to see boats heading in that direction. Historically, China, I think, for many Australians is a market of opportunity, and I think we'd be taking a similar approach to it. But the real challenge for us, if it was to open tomorrow, would be having volume able to be put into that part of the world. We've got very strong support from our underlying customer base, but a range of other growing customers, particularly in India and Southeast Asia, and interest in Europe, that servicing that, which is all of these two areas, India and Southeast Asia, are turning on blast furnaces and coke ovens, and they're not going to turn them off, and they're going to have to import 100% of the raw materials. So for us, having that confidence and surety that they will continue to need the raw materials is of value versus, say, a market which only procures, say, 10% of its raw material or its coal requirements on a seaborne basis.
Turning to Barry, in the context of what the others have said here, have you seen ready markets in these jurisdictions? I mean, I would imagine, say, Southeast Asia, Malaysia, Vietnam, those kinds of growth areas. India is obviously a big target for all of you. Talk us through, Barry, how you envisaging a book at this point.
We just don't see there's any substitute whatsoever for Australia's well-trodden path of that Japan, India, Korea, Southeast Asian market. And it's even more important if you're building a greenfield operation from scratch, you need consistent, honourable, long-term customers. And in effect, you're just rolling over your core tonnage year in, year on evergreen contracts and negotiating the price. That's the only way we see as building a business. As Fergus said, there might be opportunistic things, elsewhere. We don't rule those out, but that's not the way you build a business. So, I mean, Australia is, the Bowen Basin is an incredible place to be for consistency of supply, quality of mines, quality of coal, reliable. It's a mature basin. There's no substitute in the world for it. And I think that in our view, you match that with the same sort of caliber of customer. That's how you build a very robust business going forward. And there's plenty of demand.
Look, Barry, the way you've just described it sounds like a fairy tale, but we'll return to your story, which has echoes of nightmare in it. But Tim, your view now, you guys, you're involved with a kind of a brownfield expansion as marketers, the Millennium thing. Definitely there's huge value to be attached to brownfield expansions. And that's kind of what we're seeing at the moment through the Bowen Basin. Those people who are daring to consider greenfield face hurdles that, would scare the living daylights out of anyone. Barry will talk to that later. But Tim, perhaps can you give us some of your insights as to, the attractions of brownfield, how that works, the pros and cons, just a kind of little insight would be good.
Yeah, sure. I might maybe just add another thought to the last question before we move on to that as well, in terms of, you talked specifically about Russia and the Chinese trade ban. That's not the only sort of geopolitical thing that we're dealing with. I think it sort of marries nicely with Barry's comments. We've had India tariff its steel exports. Indonesia look at limitations at various times on thermal coal. We're as driven as much as trying to interpret policy decisions as we are by economics, and to a large extent we have to look through that because we can't react to every single decision that happens in the market in a quick time frame. So we have to try and look through that. But one trend that does seem to be clear is there's a concern for security of supply. That the underinvestment is now real, and that security of supply is foremost on buyers' minds in all regions, I think is fair to say. In terms of coming back to your question on brownfield investment, I think it's that same story. It's no controversy that to make a 10-20 year investment decision and secure capital and secure approvals and secure confidence of the market, for that has just not been possible for the less than faint-hearted. So for M, I think the vision, if you like, was being able to see through the cycle, and these opportunities and the brownfield opportunities were available in a depressed market. So really, a Millennium was it's not an acquisition that's happened sort of as markets have been at an elevated level. The opportunity was there at a time when it required some confidence that the met coal market would structurally recover, and met coal would still have a place in steel making over a decade long time frame.
The question of the future pipeline is, for me, a very, very fundamental question, and it's linked with all of the things we've talked about here. So, for example, we've just seen BHP announce that it was not going to invest as fully in its BMA operations as in its Queensland operations as it might have. other than probably sustaining capital. Access to capital, how people obtain capital, how we keep going, and also, someone like Jellinbah Group, Mark, you've got, as you said, assets that go out 30, 40 years. What kind of investment decision or proposal do you put to your board? And you say, well, by 2050, guys, it's over, Skidova, hydrogen is now replacing. So we make a squillion and then we all go home. So all of these kinds of push-pull factors, I think, are featuring in people's thinking. Just one point to make before I go to the next, before I come to you, Mark, first. But our research indicates that by around 2030, we think metallurgical global supply will be short by say 15 to 30 million tons, going into a slowing steel production universe potentially. That's what our modeling would currently suggest. We just don't see a pipeline at this moment that other than the things we're all doing, talking about here, brownfield, Barry, it's not enough, we don't think, to meet the demand that's coming. But Mark, super quickly on your future kind of positioning.
Look, I mean, we're firmly committed to the steel making coal market. I mean, we have long life assets, and we're blessed with a cost structure and a debt structure which allows us to participate in the market, at all points of the cycle. Obviously, the challenges that we have is, as we've seen, that policy changes, and it doesn't matter where it is, but policy changes. Given the fact it takes sort of now, and Barry can touch on this, 8 to 10 years to actually get approvals in place for a mine, and whether that's a brownfield expansion or a greenfield. 10 years now is a very long time in the rapidly evolving policy space. So that then puts a certain level of nervousness into the capital that needs to be deployed. And as Tim mentioned, yes, there is a certain level of bravery that's required through the investors and around the board table to be able to actually continue to invest significantly in your assets to ensure that you're there for long term. And so there's a challenge. I mean, if you have one view that the metallurgical coal industry is finished in 10 years, then it's go hard and go home or divest. Or there is a significant survivors premium that's out there in the tail for all of us who have long life assets and who are committed to this industry. Until such time as there is a completely new technology that replaces the blast furnace route, steel will be made with metallurgical coal for many decades to come.
So Barry, let's hear from you. 8 to 10 years. I'm surprised, frankly, you've still got hair, Barry. Some of us didn't think you were going to get over the line. It was a long, hard slog. Wow. Hats off to you. Congratulations, Barry. So walk us through. What's different?
Well,
what's changed?
I guess, it's been a pleasure. It's for me and for my team. It's been difficult times, but when do you get an opportunity to create a brand new greenfields operation from scratch in the Bowen Basin, the best basin in the world? You just don't. So we feel honoured to be part of the basin along with these gentlemen here, and but we've had to jump higher hurdles. There's no doubt about it. So if I just go back, back when I was running Gloucester Coal in the Gloucester Basin of New South Wales over a decade ago, we saw a little bit, I think, of what was coming with ESG back there. It's not the Hunter Valley and it wasn't Bowen Basin, it was the Gloucester Basin. So you're near a national park, you've got hobby farmers around, you could be seen from the road. You had to make sure that you were doing the right thing. So when we looked at, set up Pembroke and we looked for assets, we wanted to make sure we could meet and exceed the very highest hurdles. So part of what we're doing has been slog, but a lot of it has been clever strategy. So we see Olive Downs as non-contentious. It's in the Bowen Basin. It's next to some of these gentlemen's mines. It's not a new basin. It's not thermal coal. It's met coal. So, it employs a lot of people in a long life. There's no contentious species, et cetera, et cetera. So it's a good mine from that point of view. But after that, we had to then make sure that we met hurdles and jumped them as high as possible, because the landscape was rapidly changing. So we did deliberately seek to go over and above what was required for our EA, for our EIS. And I think that's been one of the reasons why from the time we bought it to the time we got the lease was just over 4 years, which was quite fast, all things considered. Just why I feel that we may be the last significant open cut, a mine ever developed in the Bowen Basin is some of these reasons, just to give a flavour. And mind you, let me contextualise by saying we don't begrudge any of these things, we embrace them, but this is what you need to do now. So our mine plan is fundamentally different to one you might have done a decade ago. We have to be a large mine with a very small footprint. We have to progressively rehabilitate aggressively behind us and leave landforms that are superior to what they might have been a decade ago. We're staying away from areas that we could legally mine, but we're leaving those zones, for instance, things like the riparian zone alone, where most of the flora and fauna exist. We sterilise coal, but it's a better environmental outcome. The flora and fauna and what we do is exceptional. So we have a full-time vet on site and staff, a koala and greater glider clinic on site, fully staffed. I can tell you every single koala on our concession and beyond by name, where they are every hour of the day. And we're the first ever to have tagged, to have been given permission to tag and research greater gliders. These sort of programs, forget about mining, they are something I'll happily compare with any conservation organisation in the world. They're exceptional. So we've had to do that. Every single tree that's interrupted, we have to go up with a spotter catcher on a cherry picker and test every single tree for wildlife and relocate that wildlife. Look, there's countless other. There's our conservation area. The first area put aside into perpetuity on our own land is over 8,000 hectares. There's 3 times more coming. There's a solar farm, a very large scale solar farm being built on site. There's the social impact management plan. We're the first under the Sustainable Communities Act of Queensland, where we must encourage people to live in the region rather than be purely FIFO. We must give it a real choice. So that's just a bit of a flavour. And those things cost time and cost money. We even I read today in the paper that there's talk of under EPBC factoring in emissions into EPBC grants in the future. So it's not going to get any easier. It's not going to get any easier. And I'll just add to that. That's what we did on a government regulatory basis. But on top of that, there are finance restrictions. So even 2 years ago, it used to be that thermal was the dirty word. I tell you the dirty word now, new. Don't say new with coal, right? That's worse. So as a new mine, it's very, very difficult. People will say, well, we don't need, we read a report saying there's no new mines needed in the whole world. So why are you building a new one? So these are the hurdles, things that we happily jump, but these are the things that I think are not going to get any easier. And that's why I think we're in an enviable position. And because of all we might have gone through a lot of ordeals, but we're actually delighted to be in the position we are in.
Wow, it's extraordinary what you're describing. Fergus, what are your plans for future? I mean, interestingly, the structure of your company is Adaro sitting there as an investor. Okay. Now, to Barry's point, there was a distinction made between thermal and met coal. Greenpeace as well, being one of the bodies that did so. But that license to operate has definitely been eroded. Now, what's interesting about Adaro being involved in a project such as Kestrel is, big thermal coal producer, clearly seeing need to diversify, having mining expertise and understanding that metallurgical coal, is something that would be valuable to add to their portfolio. So perhaps some views around this topic from you?
I think in terms of metallurgical coal, the future of metallurgical coal is very bright, as we've spoken about before. And I just go back to some of those earlier comments. One of the reasons it won't be just for the next 10 years and it will go on is that a lot of the capacity that's being built in the seaborne market is they're building blast furnaces and coke ovens and associated equipment, and that equipment takes a lot of capital and takes many years to service. So you're talking 30, 40 years minimum for these guys to make these decisions. They're not going to suddenly jump across because they can squirt a bit of hydrogen in through the tuyeres or something like that. It's a long-term commitment. And I think when you're close enough to the part of the coalface on this, you can see that's pretty clear logic. And I think the likes of Darrow can also see that in the future. And in addition to that, Australia is a very stable country with lots of expertise and experience in metallurgical coal. It's the mecca of metallurgical coal seaborne exports. So it makes a lot of sense for them to have interest in investing in this part of the world. And maybe Australia is becoming the only shop to go to as these other parts of the world become more difficult and less stable in terms of investment. I've had some experience working in Canada, and I saw that environment becoming, from a regulatory perspective, the hurdles lifting rapidly, and from a political environment, a significant influence on the attitudes towards, forget greenfield mines, but just old brownfield mines. It's certainly shifting. So I think Australia is behind in that process. They're more friendly to investment, but those, as Barry's just outlined, those hurdles are still lifting.
Well, to your point, Fergus, the regulatory rug could be pulled from under your feet at any time. We are in Queensland, and I won't dwell on the royalty change that none of us like, but that's an example of something unexpected coming along that changes essentially your kind of your profit margins, your modeling, etc. But the Canadian one is interesting because if you remember, a few years ago, people were going, juniors, where do we go and invest some money in a piece of land and try and get up and running? And the jurisdictions, Indonesia was a bit on the nose, risky, blah, blah. It was Australia or Canada. But now with this Canadian thing, we're back to Australia, and, the kinds of experiences that Tim's talking about with brownfield and Barry's talking about with greenfield. So, the license to operate globally is kind of shrinking, any way we look.
Yeah, incumbency is king.
Yes. Yes, indeed.
Marian, I'd add to that and say that the other thing, apart from the quality of the Bowen Basin, the thing that gives me a lot of comfort in Australia is, as Fergus said, I call it the engine room of the steelmaking world. That's the Bowen Basin. So you're in good company. So if there's anything dramatic that had to happen, that's the biggest exporter at the moment for Australia. So you can't wipe that industry out. You've got to, in some way, stay behind the industry. If you can contrast that to Canada, you could make some fairly broad decisions in the Canadian market without wiping out the biggest export of that nation. So I like to be in the engine room of Australia. I wish we I want to avoid any controversial decisions, but I like it. It's too important for Australia. It's what's kept us going over the whole COVID cycle. The wealth that's generated out of that Bowen Basin.
Let me segue from there into, I think, one of the things that you've all alluded to in various forms, and that is the shortage we face in equipment, skills. People are not, which case, let me ask it this way. If you had a young boy, son, would you be advising him to go off and study engineering, mining engineering? I don't know if I would be advising my son to do that. So, Tim, maybe we turn to you first. How have you gone about the mines you've seen, where M might have an interest or an involvement? How are you finding people to come and work there? Are you dragging people out of retirement? Have you got all the kind of taxi guys, the geologists who were driving taxis back at your mine? How are you going with that side of it?
Yeah, I guess I'll give anecdotal comments to that. But yeah, it's difficult. I think people who've left the industry and found alternatives have stayed, and it's not easy to get them back. And that's across everything. You know, it's the same comment for the train operators, as for equipment operators, as for as any aspect of the industry. And yeah, mining engineers seems to be particularly difficult. Yeah, I guess I'm slightly more optimistic that ultimately fundamentals dictate in the world, and that the world sort of will wake up that it needs these materials, and that discussion is maturing. I've got two daughters, and I think I'm hopeful that I'd support them into mining engineering in particular. No questions there.
Good answer, Tim. Barry, what about equipment? Are you going to do truck and shovel, or I think you are from memory? Have you had to order well in advance? I mean, how is it looking or are you getting contractors and leaving it up to them? Just talk us through some of those challenges.
So, looking at the challenges, Marian, we looked at, I guess we went through to a path where we couldn't risk an asset like Olive Downs on anything that wasn't top notch. So, for the mining, for instance, we've got a contract with Peirce. So, if you were going to start an owner operator mine of the scale of Olive Downs from day one, I would caution against that. Peirce have the expertise. Peirce have the volume. Yes, Pembroke and Peirce had to go and order the trucks well ahead and get in, but again, we use their firepower to be able to do that. Olive Downs will be the first mine in the east coast of Australia that has been established using the latest technology of automation. There's a lot of mines that have gone backwardly integrating, but we're the first one that's actually planned for autonomy. And that in itself almost segues back to your previous question. There's a lot of new type roles that are coming that are exciting in mining that I think will attract the younger generation because technology has a big role to play, not only in efficiency of operations, but also emissions and most importantly safety, and they'll be showcased on Olive Downs.
We'll have to arrange a visit, Barry, sometime.
Right.
Mark, are you still having problems with COVID absenteeism? And perhaps you can talk to that and the issues around, replacing older people and equipment. What sorts of challenges do you guys face?
Oh, look, I mean, COVID absenteeism, we weren't any better or worse than anybody else. I think we had the challenges generally that was in the community. We put a lot of things in place to ensure that we didn't have it on the mine side, or we had transmission on the mine side. So what you usually found were people, when they were off their shift and they acquired it in the community or away from the mine, and then were not able to return. And so far, we have surfed the wave and been able to continue to be as productive as we can be. The labour in general, I mean, as I said, we have one mine that's 33 years old, and we have some long-term employees there that are 20 plus in terms of their time in the mine. So if they're transitioning to retirement, and the attractiveness of the industry, it's all right for us here because you are preaching to the choir to some respect. It is an extremely attractive industry, but it's about getting those young people in and engaged, and it starts at the school level. I have a 12-year-old son. Obviously, I keep a one watching brief on the messaging and the education material that moves across his desk, and it is quite interesting to see where not just coal mining but mining in general is sort of pitched. So that's feeding through to the dearth of mining engineers or people wanting to get into engineering, after they leave school. And as Barry says, it is in a changing industry. That automation and that data. And the data management in there is an incredible area of growth. And whether it's you're digging a hole in a coal mine or in a copper mine in Chile, there's an awful lot of set of skills there. But the challenge is labour in general. I mean, I think we see it in all aspects of our life, and it leaves some inflationary pressures as well. But I mean, here in Queensland, there's a lot of challenges with other large infrastructure projects that are on the go here. Of course, we've got the Olympics coming up as well. So the challenge that's put there is you can either work remotely or you can work almost Monday to Friday on a Cross River Rail project, something like that, and earn the same amount of money digging a tunnel. And this is where it really comes down to that. It's that competition for labour. Coal industry is not on its lonesome on that one. This is a global phenomenon. Until such time as immigration or those levels are lifted in skilled immigration to get people into this industry, there will be a challenge in that space. So it'll drive productivity. And as Barry has said, he's setting a mine up from the get-go for automation. It's more challenging to do it retrospectively in older sites like ourselves. You can automate certain portions of the area, but it still creates new jobs. And that's whether it's driving an autonomous dozer or a fleet of drill rigs. There is still a lot of exciting employment opportunities in the industry.
Fergus, how have you guys found manning your staff, equipment, spare parts?
I think it's a similar story across the Bowen Basin. Underground mines, as we have to go through periodic longwall moves, so they move the equipment to the next panel, and in doing so, you need to access additional resources to be able to do that. The last time we did that turned out to be a bigger challenge than we'd experienced in the past in terms of just being able to get the right people. COVID was also an overlay to that, but there was also just a general leakage of skills out of the industry into other industries. And that's broad-based. It's not just the people underground or driving the trucks. It's right through the organisation, project work or DOs or the like, and all of that brings inefficiencies and challenges and cost push within the organisation as well. It is a challenge, significant challenge.
Barry, to return to you and your point about automation, very roughly, do you think you'd be at a comparable size open cut mine, say 50% lower manning levels in a traditional sense? Have you sort of quantified that once you're fully operational?
No, in fact, the savings are through efficiency, materials, diesel, et cetera. To be honest, it's simply going to be redeploying most of those jobs into other things. I mean, again, I've just said we've got a full-time vet clinic and environmental scientists. Imagine how many people are roaming around, looking after that. So I don't see there being, I think there's a very strong employment story with Olive Downs. It's just that the jobs are redeployed. I think the number one is safety. The number one is safety, which we all, I think, sometimes got to keep remembering is so important. And then the number two is efficiency and emissions and latest technology, more interesting jobs. But we're not counting on major cuts in employment. We're just looking at redeployment in other roles. Okay,
good. Looking through my questions, I think we've pretty much covered the lot. Right, we'll just do a quick round the table final words. Mark, closing remarks.
Well, I've certainly enjoyed the opportunity to talk today. I mean, Queensland Metallurgical Coal has an extremely bright future. I mean, obviously the headwinds of what we see in the short term in the global economy. When I sit down with our major customers and they tell me about their blast furnace expansion plans or coke batteries, I just look at them and say, where are you getting the coal from? And it's starting to dawn. It's starting to dawn on these people about where the high quality coal will be coming from for these assets. I think every coal region has a challenge in terms of, from a supply perspective, in terms of policy and so forth. And we're not alone, obviously, here. But at the end of the day, what we are alone on is the quality of our resources here in the ground in Queensland, and many decades ahead of demand still to go.
Thank you, Mark. Tim?
I think Mark summed it up elegantly. We share the same positive outlook that there's a need for the industry, and it's got a good future ahead of it.
Oh, thanks, Tim. Fergus?
Yeah, just echoing Mark and Tim's comments, and also my thought is, at the moment we're seeing more and more private money or higher risk appetite investment into these mines, and as the case becomes more compelling, and maybe the pool dries up in terms of who can actually partake in the investment, where do the end users come in? And are we going to see more of that, which would require for some of them some reversal of their green ESG policies and stated positions? So I'm very interested to see what happens with that over the next 10 years.
Agreed. Thank you. Barry, last word to you.
Well, again, to reiterate, we feel honoured to be in the Bowen Basin, the best basin for coking coal in the world. We wouldn't have invested 800 million if we didn't feel comfortable about the role of coking coal going into the future. The hydrogen and other technologies, they will come eventually, but what we have decades of transition where our customers need to minimise emissions through coal like the Bowen Basin quality, with responsible suppliers who are embracing that sort of approach. That's the transition story that Australia can play. And, the demand we don't worry about the demand whatsoever. If I could sort of characterise it by one conversation I had with a major steel mill, they said, look, my chairman is committed to hydrogen. That's the way, by this date, it has to happen. But he said, with a lowered voice, but I've got to procure the coal for the next 30 years. So that's the role Australia plays. That's what the Bowen Basin plays, and that's a great position to be in.
That's an excellent comment on which to end this session, I think. So I just want to thank all of you for your excellent comments and insight. It's been an absolute pleasure talking with you, and no doubt we'll be talking very soon. Thanks, everybody. We'll end it here. Thank you.
Thank you. Thank you.
Thank you. Bye-bye.